I would like to talk about commodity markets and what are the key drivers behind that significant inflation in asset prices, and here in particular in commodity prices. We think that the key driver behind the inflation in equities, in bonds, as well as in commodities is the business cycle. Commodities have performed very well in the second half of 2017, with commodity prices up on average by 16%. And really the key pillar behind this rally, and as well as behind our bullish view on commodities, is the maturing of the business cycle. It's now clear that the world economy has expanded in one of the later stages of the business cycle, where capacities are, or the output gaps are fully closed. So that means the world economy runs above capacity. And at those later stages, historically, commodities have outperformed all other asset classes, with metals prices up on average by 50% per annum. In the current cycle, metals, especially copper, nickel, aluminum, are up on 25% on average. And indeed, the world economy or commodity markets facing the best demand backdrop in at least a decade or better since the 2004-2008 era. As you can see here on the map, we have strong global synchronous growth. The blue shaded areas are showing economies in the expansion mode, and there is only a few economies in the world which are in recession actually. So the US is running above capacity. Most European Eurozone economies running above capacity. And also China is performing very well, but still below the trend growth of the past 10 years. And the second driver behind the rally in commodity prices is the depreciating US dollar. Here it's shown the US dollar versus a basket of 6 major other currencies, for example, the Japanese yen or the euro. And actually, it's not surprising that the US dollar depreciates when in a later stage of the business cycle. But it has an important impact on commodities. We think that the impact on commodities, often depreciating US dollar, is through the cost channel. Let's take copper, for example. Chile, as the largest copper producer in the world, has roughly 50% of production costs in local currency. So let's, for example, the US dollar depreciate by 10% or the Chilean peso strengthens by 10%. Then copper prices should rally in US dollar terms by 5%. So, and our colleagues from the FX research expect a further devaluation of the US dollar by 3% by year end. So that could be translated, if you take that way, that the dollar should, that the copper prices should further appreciate by 1.5%. No, and it's not true. Actually, we have done a study that if the dollar depreciates by 1%, then the impact on copper prices is actually 2.5 times as much as the depreciation of the US dollar. So actually, take this, copper prices could rise by year end to $8,000 per ton. That's, I think, a very good message for the one who wants to be invested. And as I said before, metals performing very well in the later stages of the cycle, and metals are really the most exposed commodity class to industrial production. Here we have seen the correlation between year-over-year global IP growth, global industrial production growth, versus year-over-year changes in the S&P GCI Industrial Metal Index. And I think that during 2008, 2009, you had a very nice correlation. It has broken over the course following the financial crisis, but I think that the correlation still holds at that later stages of the cycle. Going forward, 2018, 2019 will be likely to be 2 years of very strong demand growth. We have seen already a significant rally in prices, so many may now fear that we will see a significant supply response either in the US and in the US shale sector, or in metals, like, for example, aluminum or copper. No, we believe actually that supply growth is limited and that demand growth will likely outpace supply growth. That's due to either economic or political reductions. Yeah, in the oil market, for example, it's OPEC cutting production by 1.8 million barrels per day with its allies in Russia as well as Kazakhstan or Mexico. And in the metals space, it's China with supply reductions to reduce air pollution in big cities. So in oil in particular, we expect a continuation of very strong demand growth. 2017 was, except a year following the financial crisis, the best year in oil demand growth in at least a decade. There's 1.7 million barrels per day on average, where the bulk in the first half of 2017 came from industrialized economies, so in the Western world. And in the second half, we have seen a rotation back to emerging market economies. And I think that is good news for commodities, as the greater share of consumption comes, or consumption growth really comes from emerging market economies, yeah? Not in China, especially the countries who are exporters in oil. Yeah, 40% of oil demand growth comes from oil exporting economies. And that's why we believe that we can be very bullish on oil demand growth, as these countries facing higher energy intensity as well as less price elasticity. So we don't need to fear that as higher prices leads to demand destruction. Why? Let's take Saudi Arabia. If they're getting now $70 per barrel for its crude, this leads to higher economic activity in Saudi Arabia and ultimately to higher oil demand growth. That's why we believe, given a growth rate of 3.9% for the global economy and our still, in terms of current prices, bearish Brent price forecast of 65, a growth rate of oil demand by 1.8 million barrels per day in 2018. Given that strong growth rate, we believe that there need to be a supply response of oil producers, not only in the US shale sector, but also from OPEC and Russia. In 2018, we see US production to grow by 1.2 million barrels. Yeah, and indeed the rig count has significantly picked up in recent weeks. However, there remain relatively high uncertainties around that ultimate impact of, or relatively high uncertainties if that higher rig count is really translated in higher oil production. And we believe not, for two reasons. The first is US producers rethink their corporate behaviors. We have seen last year an underperformance of US oil equities relatively to the broader market, as well as to the underlying commodity. So as the oil price rallied by roughly 40% since late June, the equities have actually stagnated in the second half of 2017. So we believe that US oil producers will really focus now on an improvement of its financial metrics. So shareholder returns, cash flow accumulation over production growth. So that's why we don't need to fear that, given that very high price environment right now, that we will see 1.5 million, 1.6 million barrels or even more, which some market participants are fearing. So really, I think that this 1.2 million barrels growth figure is really the upper end of our forecast range. And that's why we believe that there's also a call on OPEC oil. The second reason why we believe that really that's the upper end of that range is logistical bottlenecks. We have problems. First, we don't have enough frac crews anymore, so oil service companies running out of or running above their capacities, and pipelines. Yeah, most of the oil comes from inland deposits, so new pipelines have to be built. They are not there yet. That's another important factor why we don't see extraordinary US shale supply growth in 2018. So, and OPEC also shows no interest yet to ramp up production significantly. So we expect now that OPEC will show very high discipline to their production cuts in the second half of 2018. So they will really keep production constant until year end before gradual ramping up production in 2019. So OPEC is committed really to keep inventories normalized. They don't want to really ramp up production significantly as they did in that run for market, or in that race for market share in the 2014-2016 period. OPEC will likely go back to a modus operandi they applied in the late 80s and early 90s, when they expanded production by 15 million barrels per day over that horizon, and had a superior market structure for them, where the market was in backwardation. That means that spot prices sitting above forward prices, and keeping, for example, now that US shale producers sidelined as they're going to hedge out production 1 year forward. And that's now what we are seeing again, that the market is back into backwardation, spot prices above forward prices, and this market structure is the goal of OPEC. So OPEC is actually committed to three goals. First is normalizing inventories, achieved. Backwardation, achieved. So now it's to ramp up production again. But OPEC's assessment of the inventory overhang shows still significant levels above that normal level. However, looking on our inventory trackers, we see that the overhang has normalized, and that OPEC is likely to overheat that normalization process. And given that supply disruptions are on the rise, we believe that oil prices will face rising volatility in the second half of 2018, as well as rising prices. Going quick to metals. In the metals market, it's the Chinese policy push to reduce overcapacity, as well as reduce air pollution in bigger cities. They started in early 2016 to cut steel capacities, as well as limiting coal working hours. Why? At those times, there were rising concerns about that debt bubble in China is exploding. So that the Chinese government was very clever. Instead of lowering key central bank rates or key interest rates by the PBOC, which would have resulted likely in a further devaluation of the renminbi and would have increased the pressure on the banks who carrying on that non-performing loans, they instead had an approach which was microeconomic and targeted via supply side reforms. Really, they went, they cut steel capacities and limited coal working mine hours, which has resulted in significant price appreciation in those industries. While coal, steel, aluminum are the most known commodities which have seen significant appreciation in prices, there are many others. The latest example is LNG. LNG didn't face supply cuts. No, they benefited from them, as there is a push from coal to switching to LNG. This has led in a doubling of the LNG price, the local LNG price in China, in 3 months, in the 3 months from October to December. Given the success of this supply side cuts, we believe that metal supply remains tight throughout the year and beyond. In the short term, really, that's the supply side reforms in China, which keeps metals markets tight. But also over the long term or over the long run, we believe that likely metal or in particular the mining sector will likely face another super cycle. Why? Here you can see the supply response to a 10% price increase in copper. When does it lead to a significant rise in production? Not tomorrow, not next year, after 9 or 10 years where we see a statistical significant response to price increase in copper. So likely we will really see a new super cycle in commodities. And that's because of that chart. In the last 5 years, we have seen a drop in mining capex by 60 to 70%. So given that long supply cycle and the drop in mining capex over the last 5 years, we believe that mining supply in copper, in coal, in iron ore, pick your commodity, we will see mine supply to decelerate from today's levels. That's why we believe that we will see a self-reinforcing feedback loop of reflation, releveraging, and reconvergence, which reinforces our positive outlook on commodities. We have seen reflation in commodity prices in 2017, which has led to a devaluation of the dollar. This devaluation of the dollar lowered EM funding costs, emerging markets economies funding costs. Lower funding costs leads to more credit growth in those countries and to more economic activity in those countries, and likely leads to more commodity demand. As a result, we have limited supply, strong demand growth. We will see further rising commodity prices. And last but not least, our forecasts, I think they are bullish, especially in the metal space, but also in oil and energy, where we see, where we are currently think about raising our forecast to $70 in the summer months for Brent oil and 68 for WTI. Are there still any issues?
Iron ore.
Yeah.
You're lower on iron ore.
Yeah, we are lower on iron ore because we believe that that shift in China, China is the largest iron ore consumer. There is a shift away from that old economy, that where is a strong focus on industrial production towards the new economy, metals, and that shift, from that shift, iron ore will likely suffer. That's why we believe that iron ore will, we are for 2018 we are not that bearish, but over the long run we are bearish on iron ore.
Do you have a position for the next 12 months on the dollar, the US dollar?
I don't have one, but my colleagues does have one. In terms of the dollar index, we will see devaluation towards 87 in the index, and towards the euro we see 126 in US dollar per euro per US dollar. Yeah.
What about the Australian money?
I mean that's an interesting question. I had a slide in another presentation where we had exactly that, the revenge, we call that the revenge of the old economy. Yeah, we have seen significant rally in commodity prices, but we haven't seen a significant rally in the share prices. So exactly what I'm talking about is we see rising prices, but when do the companies really benefit from rising prices? When they have enough capacity to ramp up, to gain also through volumes, and that's exactly what we will see. We will see rising prices, but the companies are not able to respond with new supply. So actually the underlying commodity will outperform the share prices. I'm not talking about single shares or equities, but I believe that it's better to be positioned in the underlying commodity than instead of the underlying share price or the underlying equity. Yeah.
Do you have a view on coal?
On coal?
Coal, yeah.
Which one?
Met coal.
Yeah, that's exactly what I said. Let's go back to this slide. We've seen rising imports of coal in China. Yeah, that's likely because of the supply side cuts in those countries, and or in China. So in the near term bullish, but as I said, we have seen that, or gradually seeing that shift away from export focused Chinese economy towards a service focused economy, and coal, iron ore are the ones are likely to suffer from that shift away from industrial production. Yeah.
We have one more.
Thermal coal. Would likely to see. In fact, would likely to face the same result, but maybe not as much as. But also likely to face the same result as we see that shift from coal to gas, natural gas. So that's in the long run we will see lower prices for coal.